Very interesting topic. Let us touch deferred tax. What is deferred tax and how is it different from current tax? And what are the bifurcation of these current or deferred taxes, which is known as deferred tax asset and deferred tax liability? Let us understand one by one. Very interesting topic. To understand and to have better understanding, in fact, we have to divide this word into two: deferred and tax. Tax, you already know, whatever you pay to the income tax department at the rates specified by the department. But now, what is deferred? Deferred has a meaning that we leave something or we defer something for future period. We are not doing it now, rather we are leaving it for the future period. Okay, so when something, and now something is tax. When we leave something, when we leave tax for future period, then it is known as deferred tax. And that deferred tax can be deferred tax asset or deferred tax liability. But when we come to current tax is what we pay now at the rate specified by the income tax department. So let us break down what is deferred tax and what is current tax. But for this, we have to have some understanding about income tax and Companies Act, because of these two we get a difference which is known as timing difference. This timing difference results in the deferred tax, and it could be deferred tax liability or asset. Let us understand first what is the main reason for this timing differences. See, income tax and Companies Act, these two act have their own rules and regulations which are applicable to companies which are incorporated in India. Now, the companies have to comply all these rules while they are preparing their financial statements. Now, when they are preparing their financial statements, they have to charge depreciation, which is as per the Companies Act. Please understand. But when they are filing the income tax return, then they have to follow the rules of income tax department. But now what happens? Both of them, income tax department and Companies Act, they have separate and different rules for depreciation. In fact, they have some rules which are different in respect of additional depreciation. But for now, for our understanding at the moment, we are taking only the depreciation, which is current depreciation, how it may differ from Companies Act and Income Tax Act, which results in deferred tax. Now, the companies may be following straight line method of depreciation, but the income tax for that particular company or for that particular gross block of assets, they have mandated it to WDV method. So what will happen? There will be depreciation differences when we compare these two. The amount of depreciation will be different. Let us understand with an example how it will affect the profit and ultimately the tax. Now, profit before depreciation, I have mentioned here, it will be the same. Income Tax Act and Companies Act. Both profit we have kept same because ultimately there will be a depreciation difference only. Now, as per Income Tax Act, they are saying that you charge depreciation as per their rules and it comes out to 100. Figures I am not bothered, you may take it as lakhs or millions, whatever you feel good. So income tax says your depreciation is 100. Now when you have prepared the books, you means company has prepared the books of accounts, they have followed certain depreciation method and it comes to 60 only. So what will happen when you subtract 1000, 100 will, if you subtract from 1000, you will get 900 as profit after depreciation. Only on this profit you will charge the tax. But when you have calculated based on the Companies Act, the profit is 940, which means that profit is lower in income tax department but higher in Companies Act. So in simple words, you can say the profit reduced due to the higher depreciation charged as per the Income Tax Act. Here, the profit is increased because of the less depreciation charged as per the Companies Act. So when the profit is reduced, you have to pay less tax as compared to the calculation made by Companies Act. Now, please understand, you have to compare these two. These are not separate companies, these are same companies. Calculation is made different, but ultimately the result will be in the form of deferred tax asset and liability. So you have to compare these two profit. Which is more? Of course, this profit is more. So now here you are paying less tax. Finally, you have to pay taxes as per Income Tax Act while filing the ITR. So ultimately you are paying what? Less tax. When you pay less tax, then you defer that taxation which is not paid now for future, and hence that creates a liability that yes, you have to pay in the future. So that is why we create here a deferred tax liability in the books of accounts, and it is shown in the liability side. Okay, let us take one more example. I've taken the same profits for both the provisions. This is the same company. So now in this case, depreciation is 100 for income tax and 150 for Companies Act. Now depreciation is being charged more in Companies Act, so profit will get reduced. But income tax says that no, we are not allowing 150, we are allowing only 100. So profit will get increased. Here the profit is reduced, but ultimately you have to pay more taxes because you have to file ITR based on the rules of the income tax department. So no matter what profit you have arrived at following the Companies Act, ultimately you have to pay taxes as per the Income Tax Act. So as per Income Tax Act, profit is more, so taxes will be more. Now if you are paying more taxes now, so the benefit of more taxes paid you will get in future, and that will create an asset for you. That is why we create a deferred tax asset in this case, and this will be shown in the asset side of the balance sheet because it is your asset, and the benefit of this you will get in future. Now in short, you can just go through this chart. Very simple. If Companies Act profit is less, income tax profit is more, ultimately you have to pay more taxes, and then you create deferred tax asset. Asset is created. And on the other side, when Companies Act profit is more, income tax profit is less, ultimately you have to pay as per the Income Tax Act. So you paid less taxes, but there is a liability created in future, so it is a deferred tax liability. Okay.